How many years do you need to become a billionaire? Some have achieved the feat in decades, and a few others have reached the milestone in only a few years. It mostly depends on the person and the circumstances. But one out of the few that have reached the impossible milestone outperformed the rest. In the early days of Facebook, Eduardo Saverin invested $15,000 into Facebook. But he left Facebook after a year because of his rocky relationship with Mark Zuckerberg. But his little investment of $15,000 turned him into a billionaire. His current net worth today is just over $11 billion. Not everyone gets such opportunities, and people often have to build their wealth from nothing. And one of the ways many achieve this is by investing. Hey go-getters, welcome back to The Early Investors. Another profitable episode where you can learn how to become financially free. In today's video, we'll be showing you the 7 rules of investing for beginners. Want to become the next Warren Buffett? Stay with me to find out all the tips and tricks to save your hard-earned simoleons. Before we jump into the video, make sure to subscribe to our channel for more business-related content. If you want to be one of the few people who actually profits from investing, you have to master the rules of investing first. And the first rule you need to know about investing is that you need to start now and start small. To fully become an investor, we all have to start from somewhere. It doesn't matter if you don't know what a mutual fund is. It doesn't matter if you don't know what all these are, because there are so many small investment platforms that you can jump in on even right now. To be honest, even I didn't know anything in the beginning, and I started investing with only $100. And I learned things as my investment portfolios grew. And if you're watching this right now, the chances are that you probably don't have $1 million to start investing. There are plenty of apps and platforms that can help you get started with investing, and the first rule heavily depends on that. You need to get started and you need to do it small. This is all about gaining experience. That's the major difference between an experienced investor and a beginner. This brings us to rule number 2. Don't get emotional. When I first started out in investing, I used to panic in every situation. I focused more on my emotions than looking at the facts and being more logical. The investing market can be crazy. I have made tons of mistakes while starting out and lost many good opportunities because I was emotional. One of the major differences between an experienced investor and a beginner is that experienced investors are able to look past their emotions and make logical and good financial decisions. Experienced investors know how to accurately navigate a chaotic market where most beginners play into their fears. To begin investing, you need to invest in 3 types of companies. 1. It should be a stable company that is steadily growing. These types of companies can almost guarantee that your investment can grow over a period of time. 2. Undervalued stock. Some companies have undervalued stock that has the potential to give great returns on investment in the future. Maybe the company recently got bad press reviews due to minor issues, but the stock value will surely return to its actual price over time. The 3rd type of company you should invest in are companies that have huge potential, like startups that could become future industries or are working on groundbreaking tech. But these types of investments require you to be logical and have a good knowledge of the industry. You can't just invest in something because the company name sounds cool. Time is money. Now, I know that many of you have heard about compounding interest at some point in your lives, but what does this truly mean? In a nutshell, this is just the idea of your money growing over time. The magic of compound interest is that even with just a few $1,000s, you could potentially earn millions over time. Just to give you a basic idea, if you were investing about $100 a month and you're making 10% interest over a 10-year period, you would have accumulated $20,000. The message with this rule is clear. The earlier you start, the bigger the advantage you would have. Investing is not gambling unless... If you ever hear anyone tell you that investing is gambling or similar to gambling, you should probably throw their financial advice down the drain. The chances are that these people don't have a major understanding of the market. They probably don't even know what compounding interest is. Before I got into investing myself, many people who weren't even investing themselves told me that I was more likely to win millions in gambling than earning passive income by investing. Investing is not gambling. It relies on data and statistics unless you're looking to make a huge profit on an investment that you don't understand. Take, for example, the Bitcoin boom. During its peak, many people, including my neighbor who didn't even understand the basics of investing, bought into it due to the hype, looking to make huge profits. But when the hype died down, many people like my neighbor lost their money instead. This can also come in the form of penny stocks. I've seen many people who've invested in penny stocks, and rarely have I seen someone make a profit out of it. For those of you who don't know what penny stocks are, they're just stocks you can buy for a few cents, and they aren't usually traded on the official stock market. Diversification isn't always good. How many stocks do you think you should own? Some people say 10, while others say 20. And some experts also suggest 30 or 40 in order to diversify your portfolio. But suppose you get a chance to invest in a great company, a company that has great products, an excellent team of management, and a strong financial statement. Would you rather invest in other companies or this company? You might say that there aren't many companies like this, true, but there are a few great companies, such as Berkshire Hathaway, Pepsi-Cola, and Apple. These are huge companies that can tackle almost any situation and are guaranteed to come out of any hurdle. Each of these companies has doubled its stock value since the last recessions. So, how much stock should you own? The answer is simple, as few as possible, but this doesn't mean that you should put all your eggs in one basket. And you also shouldn't poke your finger in every pie. Keep it small and simple. Investing in a few great companies can usually give you great returns. Every investment you make is going to take a significant amount of time reading the financial statements and keeping up with the company and how it's performing. You are going to lose money. Something you need to be aware of before diving into investing is that you are going to lose money. It doesn't matter how great of an investor you are. It is almost certain that you are going to lose money no matter what, and a lot of people can't stomach this. Most of you have never been through a financial crisis like 2002 and 2008, and a financial crisis is a test of endurance. You might be really confident about how you can handle a financial crisis, but you wouldn't really know until you've been in such a situation. Suppose you have a $100,000 portfolio and you lose $40,000 over the course of 2 months. You're definitely going to freak out. Many people would straight up withdraw from the market out of panic, but in a situation like that, the chances of you coming out with a profit depends heavily on how long you stay in the market. It's going to be a battle of endurance. The market is going to be a tough sea to navigate, and it's not smooth sailing all the time. It will constantly challenge you and push you to the brink. And you will lose something, but the longer you stay in the market, the more are your chances of gaining back the losses you've endured. The stock market isn't your only option. When you first hear the word investment, the first thing that comes to mind is the stock market, real estate, or government bonds. Although they are great investing tools, they aren't your only options. Investing can come in different forms. And sometimes the best investment can be the business idea that is lurking at the back of your head. It can also be in the form of side hustles and other forms of passive income. If you have plenty of time on your hands, perhaps the best investment can be an investment in a course that can teach you a new skill that you could capitalize on. Investment doesn't have to come in the form of immediate materialistic gains. It can also come in the form of self-help or finance books that will have a bigger impact on your life in the long run than any other kind of investment. The opportunity could be right in front of you, and you could just be turning a blind eye towards it. So, the point is, keep your eyes peeled and think outside the box. With all of this said, I hope you guys enjoyed the video, and if you did, make sure to subscribe to our channel, and make sure to turn on the bell icon to never miss out on our amazing content.